Okay, let's dive right into this. Welcome to today's explainer. If you've ever looked at a financial chart and just felt completely, totally overwhelmed by all those jagged lines, flashing colors, and endless numbers, well, trust me, you are definitely not alone. But today, we're going to completely demystify that whole experience. We're building what I like to call a micro to macro trading system, relying entirely on some brilliant source material from trading educator Jason Greystone. We're going to start with literally the absolute smallest increment of market data, and then we're going to build it all the way up to the overarching risk math that professionals actually use to protect their capital. Let's do this.
So here's a quick roadmap for our explainer today. We're going to hit Candlestick Anatomy first, then explore the Tug-of-War, identify market phases, spot support and resistance clues, calculate trade risk, and finally look at the Positive Expectancy Formula.
All right, Section 1, Anatomy of a Candlestick. The absolute building block of financial charts. The candlestick is basically the ultimate building block of financial charts. It represents the absolute smallest increment of market data, which is just price measured over a specific time period. Now, what's really interesting about this visual representation is that these four simple data points, the open, high, low, and close, they actually tell a complete, undeniable story of a trading session. Whether that session was, say, 15 minutes, an hour, or even an entire day, an OHLC candlestick gives you exactly where the price opened when the session started, the absolute peak high it reached, the absolute lowest point it fell to, and then finally, the exact closing price when the session ended. It's just this perfect, neat little data snapshot. So when you're looking at a chart, you're essentially looking at this giant battlefield of green and red. A bullish or green candle basically means the buyers won that session, right? Because they managed to push the price to close higher than it originally opened. And conversely, a bearish or red candle means the sellers threw their weight around and took control, forcing the price to close lower than the open. That final closing position is the whole key. It totally dictates the color and the direction of our little block. Moving right along, Section 2, the Tug-of-War, uncovering the battle between buyers and sellers. Now we're going to take that static visual data point we just talked about and turn it into a dynamic, essentially human story. Jason Greystone puts it perfectly in our source material. He says, imagine like a game of tug-of-war, buyers trying to win, sellers trying to win. Because price, it doesn't just move in a perfectly straight line, does it? It fluctuates, sometimes really violently up and down. And those wild fluctuations create what we call wicks, basically those thin little lines you see extending above and below the solid colored body of the candle. By learning to read these wicks, we're basically hunting for clues. We're looking for deceleration or major momentum shifts in that tug-of-war. Take a high-test candle, for instance. A really long wick on top shows us that buyers aggressively pushed the price way up, but then strong selling pressure just stepped right in and violently rejected it, shoving the closing price all the way back down. Wow, right? Then you have something like a Doji candle, where the price opens and closes at the exact same spot. Literally, the exact same price. It's the ultimate picture of total indecision. Neither side could win the tug-of-war. Okay, Section 3, identifying market phases. Zooming out to see the overarching picture. Now that we totally get how to read individual candles, let's zoom out a bit. We need to look at the broader overarching trends that these candles are actually forming. Markets essentially move in four main conditions. First, you've got bullish, which is your classic upward trend, moving from the bottom left to the top right. Then bearish, a downward trend, going from the top left to the bottom right. Then there's ranging, where the price is just moving sideways, kind of bouncing harmonically between two clear boundaries. And finally, choppy. Choppy is just erratic, messy, and all over the place. And our golden rule here is a strict if-then scenario. If the market is choppy, then we stay completely away. Seriously, hands off the keyboard. There is absolutely no mathematical edge to be found in total chaos. Now, inside those nice, healthy trends, the price moves in specific phases that we call runs and pullbacks. A run is basically the primary extension going in the direction of the trend. It's the big move. A pullback, on the other hand, is the temporary retracement, a little correction moving against that trend. And here is an absolutely vital takeaway from the source material. Rookies almost always buy right in the middle of a run, simply out of FOMO, the fear of missing out. But professionals, they wait patiently. They wait to enter during a pullback to ensure they get the absolute best price possible. Section 4, Support and Resistance Clues, Finding the High Probability Turning Points.
So, you're probably wondering, how do we actually pinpoint exactly where those pullbacks are likely to end so we can safely enter the market? Well, we find these turning points by identifying what's known as support and resistance. Traders literally just look left on their charts to find these historical turning points. Support acts as a floor. It's a level where declining prices have historically bounced back upward. Resistance, conversely, acts like a ceiling that has historically rejected rising prices and shoved them right back downward.
And this brilliantly illustrates one of the most powerful phenomena you'll ever see in a trending market. Previous resistance often becomes new support. So, when a strong upward bullish trend finally breaks through an old historical ceiling, guess what? That old ceiling typically turns around and acts as the brand new floor during the very next pullback. It's like climbing stairs. And this is precisely where professional traders start aggressively looking for their entry signals, like those high test or doji candles we decoded earlier. All right, Section 5, Calculating Trade Risk, Protecting Your Capital with Strict Mathematical Rules. We are now shifting gears from chart analysis to the overarching safety net of risk management, because let's be real, without this, your chart reading skills are virtually useless. The absolute secret to longevity in the markets is protecting your capital with strict, unbreakable mathematical rules. Let's break this down step by step, all right? First, a super common professional rule is to risk a strict maximum of 1% of your total account size on any single trade. So let's say you have a $10,000 account. Your absolute maximum dollar risk on a trade is $100, period. Step 2, you measure the distance between where you're entering the trade and where you place your emergency stop-loss order. Let's imagine that distance is 50 pips, which is just the standard unit of measurement for price movement. And then, step 3, simply divide your $100 risk by that 50 pip distance. Doing that math leaves us with exactly $2. So what does that actually mean? It means that to safely execute this specific trade while perfectly honoring that 1% risk rule, the trader can risk exactly $2 per pip. It literally doesn't matter if the market goes wildly, unpredictably against them and smashes their stop loss. Mathematically, they physically cannot lose more than that predetermined $100. Let me tell you, a loss stings a whole lot less when you've already planned for it down to the penny. This right here is exactly how professionals trade without emotion. And finally, Section 6. The Positive Expectancy Formula, the mathematical proof of a profitable system. Now, once your risk is strictly managed, you obviously need to know if the system you've built will actually, make you money over a large sample size of trades. So the crucial point here is how we prove our profitability using this very specific formula highlighted in our sources. You calculate this by looking back at your historical test data. You're going to need 3 variables. W is your average win amount, L is your average loss amount, and P is your strike rate, or basically your winning percentage. The formula itself, it's simply 1 plus the average win divided by the average loss, all multiplied by your strike rate, minus 1. I know that sounds like a bit of a mouthful, but it's pure magic when you run the numbers. When you actually plug all your historical numbers in and run that equation, what you're looking for is incredibly simple. As the source material plainly puts it, as long as that is above 0, it's profitable. The further above 0, the better. Simple as that. For anyone seriously focused on learning this, seeing a positive result here is basically your ultimate mathematical green light. It completely proves that despite the inevitable losses you're going to face, over time, your system essentially prints money. Wow, we have covered a ton of ground today. Everything from the microscopic anatomy of a single candlestick to the overarching market trends, all the way down to the exact, precise math required to fiercely protect and grow your money. But listen closely, because none of that matters without one final element. So I'm going to leave you with this somewhat provocative thought to close out our explainer today. Do you actually have the mental discipline to strictly follow your system, meticulously cut your losses early, and just let the probabilities play out? Because as we've clearly seen today, the math behind all of this is absolutely bulletproof. But human emotions? Yeah, not so much. Thank you so much for joining me on this explainer. I really hope this helps clear the noise for you, and I will definitely see you on the next one.